Good morning, everyone. Welcome to NOVA 401k Associates Secure Act 2.0 and Washington Update webinar. We have added the slides as a handout. Just click the handout drop-down on your GoToWebinar panel, and you can download and save the file to your local folder. If you have any questions, please type them in the questions box, and we will answer them throughout the presentation. Please now welcome James Hansen, who will be introducing our speaker today, Craig Hoffman.
Hi, good morning and good afternoon, everybody. I'm James Hansen. I'm the regional sales consultant for the Georgia and Alabama market based out of Atlanta. And I want to thank, of course, my advisors here in the Southeast and also everybody that's attending around the country. I believe all the NOVA sales team jumped on this and sent it out to their respective advisors. So we appreciate everybody's attendance. We will be taking questions this afternoon. There should be a question box on your go-to dashboard where you can enter those questions, and I'll be reading them to Craig. So we would, always appreciate feedback and questions. And without further ado, I will turn it over to Craig for a unique perspective on the industry. Craig?
Thank you, James. Hello, everybody. Good to be with you. I saw some of the names I recognized on the attendee list. I know there's some new names, so if you're interested, that's who I am. I'm happy to be here at NOVA. I've been in the industry close to 40 years now. Spent 10 years as a lobbyist and general counsel for the American Retirement Association. So what goes on in Washington remains of great interest to me and to us here at NOVA. We have been active and continue to work through our various contacts to help mold legislation, and this is some of that found its way in a Secure 2.0. So, the normal disclaimer, all that good stuff. So what are we going to talk about? Well, I am going to focus primarily on the Secure 2.0. Its proper name is Securing a Strong Retirement Act of 2021. I expect that will take up most of our time, depending on questions. If we do have time, I'm also going to hit upon quickly a couple of other legislative proposals that I think would be of interest to you as advisors in the space. So let's begin. Secure 2.0 is building upon Secure 1.0. As we know, at the end of 2019, a pretty major pension reform bill was enacted by Congress. We've been dealing with that ever since, putting it into place, but literally even before Secure 1.0 was enacted, there were already follow-up proposals that have come to be called Secure 2.0. They've been percolating for the last year and a half, and we have a pretty major bill that covers a range of issues on the retirement front. The bill was approved unanimously by the House Ways and Means Committee. That means it was a voice vote. And I have no wife. I actually watched the markup of the bill by the House Ways and Means Committee. And normally that's a contentious process where there are amendments offered back and forth and votes taken. This markup was a joy fest in bipartisanship, as members of Congress on both sides of the aisle took their allotted time to say what a great thing this is, we can work together, and most of them have some bit of legislation that got included. So the reason I raised that point is it does bode well for this ultimately to become law. If you remember, the Secure Act, when it was passed by the House of Representatives, passed by a vote of 417-3. You cannot get really much more bipartisan than that. And at the same time, this bill has been passed by the House Ways and Means Committee. Very similar legislation, sharing many of the same provisions, has been introduced. It was introduced May 21st, I believe, in the Senate by Rob Portman and Ben Cardin, two senators who have a long history of working in the retirement reform space. And so I think there's a very good chance this bill is going to become law. We'll talk near the end about when that might happen. What's in it? Well, there's a lot on 401k plans. To begin with, the new law, if it becomes law, I got to be clear about that. Should it become law, every 401k plan will have to include as part of its design automatic enrollment and automatic escalation. You'll begin at 3%, go up to 10. There's a window you might be able, you go to 15 at some point if you want to. But the idea is you got to start at 3 and go up 1% each year. Now, it's for every 401k and 403b plan that is established after the date of enactment. So it grandfathers existing plans. They will not need to add auto enrollment, but any new plan after the date of enactment is going to need to include these provisions beginning with the 2023 plan year. Also accepted are small businesses that have 10 or fewer employees, as well as new businesses that have been around less than 3 years. Church and governmental plans are also accepted. Going hand in hand with requiring more automatic enrollment, the bill would memorialize into the Internal Revenue Code a mandate that reasonable errors that occur in implementing auto enrollment or auto escalation can be corrected up to 9.5 months after the close of the plan year. The correction's got to be favorable to the participant and non-discriminatory, whatever that means. But what this does, the IRS in the Employee Plans Compliance Resolution System, EPCRS, already has a safe harbor that's very beneficial, that this is really meant to memorialize in the code. The problem with the IRS safe harbor is it is subject to their whim and discretion. And in fact, it expired, that safe harbor method, 12/31 of last year. But the good news is we just got, literally Friday of last week, a new EPCRS revenue procedure that extended that safe harbor for 3 more years. So we're good on that, but this makes it, not an option for the IRS, but rather a mandate from Congress that they continue this type of correction, that it doesn't expire in 3 years or ever, unless Congress changes the law.
Hi, Craig, we had a question.
Okay.
In regards to the mandatory auto enrollment and auto escalation, is that new legislation or an enhancement or update of the original Secure Act?
It's new legislation. The Secure 1.0 had nothing with regard to auto escalation. And I should add, going back to this, this is not a mandate that you have to have a 401k plan or 403b plan. It merely is now a new qualification requirement that every 401k or 403b will have to include. There is, if we have time, and if we don't, just take a look at the slides, but the chairman of the Ways and Means Committee, Richie Neal, has a not bipartisan program or proposal that would require all employers to adopt a 401k or 403b or payroll deduction IRA program. This is not that. This is just a new design mandate if you're going to have a 401k plan. Moving on, long-term part-time employees. This was part of Secure 1.0. It requires us to allow employees who have completed 3 consecutive 12-month periods with 500 hours of service at least. They must enter the plan and be able to make elective deferrals. Now, I'm not going to go into all the details on that. It takes effect. It took effect this year, but you don't have to count eligibility service until this year. So few plans have tried to implement this yet. The point to be made, however, is Secure 2.0 drops the 3 consecutive 12 months periods down to 2. And this is a priority for the chairman of the Ways and Means, Richie Neal. He listed it in his priorities for the committee at the beginning of this Congress. And it is effective as if it was originally included in Secure 1.0. So that means instead of looking at people coming in 21, 22, 24, they now may be coming in as early as 1/1/2023. So we still have a window to prepare, but it will ratchet up the long-term part-time employee population in your plan potentially. Oh, this is new. This was added to, I should have mentioned, the Secure 2.0 was introduced at the close of the last Congress as it was getting ready to adjourn. So it expired, if you will, and the version we're talking about is the new and improved version, you might say. And it has a provision that is inserted principally to raise revenue that will offset the revenue lost by other provisions in this bill. They designed it to be revenue neutral, so it doesn't cost the federal government anything over time. And the way they pay for it is by mandating that for 401k, 403b, and 457b type plans, catch-up contributions will still be available, but they will only be available in the form of Roth type contributions. Now, people are some like Roth, some don't. The reason why this raises a lot of money is because they look at a 10-year budget window, and in a 10-year window, the contributions are going in on an after-tax basis. And so in the short term, it raises a lot of money, but it's really, if you look down the road past 10 years, it's going to lose money down there, but that doesn't matter. We're making sausage here in Washington, and they present this as again, a revenue raiser. It would actually raise, the catch-up provision would raise $13.2 billion over 10 years. It would also allow employers to make matching contributions on a Roth basis. And somehow they scored that as raising $12.8 billion over the next 10 years, which is ridiculous. I don't see anybody really dealing with it. There's also an issue with the catch-up contributions from an administration standpoint as to when you fail an ADP test and you recharacterize elected deferrals as catch-up contributions. We're not clear how that's going to work with this Rothification provision, but I expect this to be in the final bill because it is the pay-for that pays for everything else. Solo 401k plans. If you recall from Secure 1.0, it is permitting us to establish plans up until a new plan up until the due date of the tax return for that first year that you want to take the deduction for. And so that actually, that took effect this year, and a lot of advisors I know have used that to good measure in dealing with your clients. And so this provision builds on it. The IRS position is elective contributions need to be made out of compensation before it becomes available. If you adopt a plan after the close of a year, retroactive, you don't have any compensation to make deferrals out of. This bill only for single employer, owner-only plans, I'll get there eventually, they will be permitted to make an elected deferral contribution up until the due date of the tax return, but without extensions. You can adopt the plan up to the extension due date, but this elective contribution mandate's got to be done only to the actual deadline. Again, it juices up a little bit of what you can put into a solo 401k with catch-up contributions potentially. So And that takes effect immediately, plan years beginning after the date of enactment. I'm going to go through the student loan matching contributions have been very popular, and I shouldn't say have been very popular. They have been growing in popularity, but they have problems because the contribution, the idea is we're going to make a contribution to the plan that matches your student loan repayment. And it's to help a lot of younger employees who need to pay their loans and can't afford to save and get no match. This would allow them to do it. The problem right now is that matching contribution, if you will, is not officially a matching contribution under the non-discrimination rules. So it's tested differently. The long and the short of it is this fixes that problem by having the contribution that matches a loan repayment will be treated as a matching contribution for purposes of the ACP test, and you will be permitted to run the ADP test separately just on the group of employees receiving the student loan matching contributions. It's a geeky technical fix, if you will, but it gives the opportunity to more easily perhaps sell this design feature to employers who are looking to help employees deal with student debt. Let me move on. Here's a fun one. I think it's fun. Gamification. The 401k regulations say it is impermissible to condition any benefit other than a matching contribution, to condition any benefit on whether an employee elects to contribute or decides not to contribute. So that means that you can't give them anything else. Well, behavioral economic studies have shown that relatively small financial incentives can move behavior. And that, for example, if you enter every employee who contributed at least 2% of pay in a monthly drawing for a Starbucks gift card, you're likely to have increased participation, even if it's for a chance at a $50 Starbucks card. If you did that today, it would violate this contingent benefit rule. The bill would permit de minimis financial incentives to employees for contributing to the plan. So again, I think this is a good rule and can open up some ideas to help employers get more employees participating in the plan. Hardship. We administrators have to deal with participants applying for hardship distributions. There's been a bit of a brouhaha over the last few years about the documentation that's necessary and how that's kept and whether you can use electronic and whether the employee can certify. Well, this bill will make it much easier for plan administrators. It will allow them to rely on the employee certification that the hardship distribution is on account of a financial need. It's got to be an immediate and heavy financial need that is in the safe harbor regulation standards. They include, buying your principal residence, keeping you from being evicted, medical expenses, the list. Well, the employee can certify that, yes, I need this distribution to pay my doctor's bill, and the amount I'm asking for is the right amount. And the plan administrator will then be able to rely on that certification unless they have actual knowledge to the contrary. And similar changes are made for both 403B and 457. Right now, the IRS regulations allow the employee to certify that he or she does not have cash or other liquid assets. And those are the three prongs to the test. Do I have a financial need? Do I have other assets? Is the amount not in excess of the need? And at the end of the day, when this is enacted, if it is enacted, we as administrators will be able to rely on all three prongs for the employee to certify. So that should make it easier to administer these hardship distributions. So there's a lot on 401k, but there is a plethora of other provisions, and I just kind of looped them all together as other provisions. They run a wide breadth. Required minimum distributions. There has been a push in recognition of the gaining longevity of Americans, that requiring people to take money at 70 and a half if they don't need it is not good retirement planning. So Secure 1.0 moved it back to 72. Secure 2.0 moves it to age 75, but does so over a 10-year period. So for those born between 50 and 56, it will be 73. It's 56 to 59, 74. And if you were born in 59 or later, you will have an age 75 required beginning date. And so that's helpful, but it costs a heck of a lot of money in the form of foregone tax revenue. This is what needed to be paid for by Rothification. And you can see it's $6.8 billion in lost tax revenue. And originally, the plan was to raise it immediately to 75. There's no doubt this was dragged out to lessen the overall revenue loss over that 10-year window. What else? In the R&D area, there's a 50% excise tax applied when you over-contribute to an IRA. There's also a 50% excise tax on excess accumulations, which essentially is an excise tax on failing to meet your required minimum distribution. That tax is on the individual who didn't receive the distribution. The bill would lower that tax to 25%. And I just noticed I neglected to put that bullet in there. But so it does that. That's one good thing. The other thing it does is it finally gives a statute of limitations for the IRS to collect these excise taxes. Because right now, you've got to file the excise tax form 5329 in order to begin the statute of limitations. But if you don't know, nobody files that when they fail to make a distribution. And so now the statute of limitations, so essentially unlimited statute.
I couldn't hear what you said.
Oh, my watch is talking to me. Sorry, folks. Does that sometimes, even when you least expect it. Anyhow, before I was interrupted by my watch, what a world we live in. The statute will now begin as of the year the income tax return would have been filed that gave rise to the excess tax obligation. So it's an improvement, certainly. It's still a hefty tax, nevertheless, even at 25%. Increased catch-up contribution limits goes for older individuals. For the over 50 crowd, it's still the normal limit, but sorry about that. But for individuals who are age 62, 63, or 64, it's a magic little window of 3 years. Your catch-up jumps from 6.5 to 10K in 401k, 403B, and to 5K in simple plans. This increase, though, is no longer available at age 65. The original bill would have just let everybody from age 60 to 65 make catch-up contributions at this higher amount. Again, it costs too much money. And the main proponent behind this provision were the airline pilots, believe it or not. Why? Because they have a mandatory age 65 retirement age. And their lobbying was clearly pushing for this, and the Ways and Means Committee markup the congressman who represents the district in Atlanta that has Hartsfield International Airport was the one who spoke about how great this was, and the airline pilots will really benefit. So thank you to my colleagues, et cetera, et cetera. Again, giving you a little background on how the sausage is made. It would also, this bill would add a cost of living adjustment to the $1,000 IRA catch-up limit, which has not yet had a cost of living adjustment. What else? Top heavy. Top heavy, you know, it's still out there, and it's less of a problem these days than in the past. But one area where there is concern is in the 401k area, where no good deed goes unpunished, you might say. A nice employer says, we'll let everybody into the 401k plan after a month of service. And turns out the owner of the business has been there a long time, and the plan is top heavy. Well, that good deed of letting people in sooner than was required will result in those 2-month type people being entitled to a top-heavy minimum, assuming they're still a participant in the plan at the end of the year. And so that discourages particularly smaller employers from letting people in sooner. The purpose of this provision is to disincentivize to remove that disincentive by, how would it do it? It would say that the top-heavy requirements are to be applied separately to participants who have not completed a year of service or attained age 21. We call those the excludables. And so it would appear if you do not have any key employee in that group of people in the plan who have less than a year of service and have not attained age 21, that separately tested plan would not have a top-heavy minimum, because the top-heavy minimum is the lesser of 3% or the greatest amount allocated to a key employee. So it's a good rule and may encourage many more smaller employers to adopt, to let folks in sooner rather than later. Where are we? All right, tax credits. We got a great increase in the tax credit, startup new plan, small employer, startup tax credit. It went in the Secure 1.0, it is now 50% of administrative costs up to an annual cap of $5,000. So if you spend $10,000, you get a $5,000 credit. And administrative costs, I mean, it's the starting up the plan, but it also is the cost of administration, as well as any employee educational expenses. And the costs have to be paid by the employer. They can't be paid out of plan assets and qualify for the tax credit. It's again, new plan, 100 or fewer employees, first 3 years, 50%. The bill would ratchet up that credit for small employees, defined as 50 employees or less. And the credit would then be 100% of expenses up to $5,000. So for the smallest employees, that would cover, smallest employers rather, that would cover certainly most, if not all, of the expense of setting up the plan and potentially administering it for the first 3 years. So that's a selling point I think you all can use out there in the real world to help the small businesses ratchet up and perhaps put in a plan. There is also an additional credit for defined contribution plans only that essentially pays for part of the employer contributions made over the first 4 years of this new plan. And the credit would be 100% of $1,000 for the first year, 75% of $1,000 in the second year, 50% of $1,000 in the third year, and 25% in the fourth year. So of an employer who got $8,000 over 4 years, they would be, actually, I take that back. It'd be $2,500 of $4,000 contributed over the year. So that's a pretty hefty part of the contributions being made. Something that, again, can be used to sell this to the potentially smaller employers. And it's available at that number at 50 or less. Between 50 and 100, it's prorated and phased out. So even up to 100 employees, there's potentially some benefit there.
Craig, I have 2 questions for you.
Okay.
Would the cost of, say, using a 316 be eligible for a credit?
Yes, if they're, as long as it's being paid out of plan, not being paid out of plan asset.
All right, and the second question is the tax credits. Would those be available for 403B plans as well?
Yes, they sure would. And continuing with tax credits, this is something I think that this fix to Secure 1.0 was an oversight in 1.0 that many of us didn't see, frankly. But long story short, that startup tax credit is only available for the first 3 years of a new plan. If you join a MEP, that's, even though you are joining that MEP, it's a new plan for you. If that MEP had been in existence for 3 years already, the tax credit would be lost because it's beyond being a new plan. The Secure 2.0 would base the 3-year period for when an employer joins the MEP, not when the MEP actually got established, assuming the employer didn't have a prior plan, of course. It's got to be a new plan, but it will be effective with respect to plans established after the date of enactment. So again, that came as a surprise to a lot of folks, but and some thought the IRS could overlook that, but it does need a legislative fix, and 2.0 would do that. Military spouses, this is a long and involved provision that's probably not going to be used that much, but the idea is military spouses that have to move often when their military member spouse gets deployed or redeployed or moved between bases. And so to encourage employers to hire military spouses, there's a small tax credit of $250 plus 100% of contributions up to $250 if made for a military spouse, but that spouse can't have more than a 2-month from hire eligibility requirement, and the contributions have to be 100% vested. This may be popular certainly in businesses that are near military bases, but I don't see it necessarily being widely used myself. 403B plans. We had a few things, helpful things on 403B. One, it would allow 403B plans to be established as a multiple employer plan. That was not part of Secure 1.0. There was some effort while it was being considered in the spring and fall of 2019 to add it, but that, as they say on Capitol Hill, that cake was baked. They did not want to, the leaders in Congress didn't want to reopen up that bill to new changes, and so it was held back and now finds its place in 2.0. Also, another correction, if you will, to 1.0, it will allow 403B hardship distributions to be made from not only the principal amount of contributions, but also QNEX, QMAX, and earnings on those accounts. That change was made for 401k plans, but not for 403B. In Secure 1.0, this fixes that. And then lastly, a provision I think may be of interest to you folks out there, the 403Bs cannot invest in CITs, collective investment trusts. And the primary reason is securities laws, to be very candid. And as I'm sure many of you are well aware, CITs have been promoted as a very cost-effective method of providing investment alternatives to folks in defined contribution plans. It could work for 403Bs. In fact, the bill actually gets in and amends the securities laws as well as the 403B code provisions to allow investments in collective investment trusts. So that's a good development for those in the 403B world. Oh, here's a good one too. This was new, and I must, as I mentioned, I was a lobbyist for ASPA, and I give credit where credit was due. ASPA was certainly involved in this provision. When we test for non-discrimination, we've got to aggregate all commonly controlled entities. And we look at, 5 or fewer owning 80% or more and yada, yada, yada. But part of that ownership determination is not just stock or ownership interests you own of your own right. It also includes ownership interests that are attributed to you, that you're deemed to own for various reasons, including a close family member, such as your spouse. And in fact, a spouse is deemed to own the stock in a business that his or her spouse owns and vice versa. So you've got, a doctor spouse and a lawyer spouse, each have their own practices, not involved with each other to any degree, but they are a controlled group of businesses that have to be tested for non-discrimination as if they were one, because the doctor is deemed to own 100% of the lawyer practice and vice versa. Now you're saying, but wait, Craig, isn't there an exception? That doesn't always happen, and you're right, there is an exception. It's the non-involvement exception, and it's set forth there on the screen. And it basically says, if I'm not involved in my spouse's business, I don't participate in the management, there's no restriction on how I dispose of it, no more that it's an active business, not a passive activity. As long as I have no direct ownership and I'm not involved with it, you will not have to attribute your spouse's stock, my spouse's stock, to me. So in most cases, the spouse non-involvement exception works. However, there are 11 states in the country. Notable among them is Texas and California. There are others that follow community property laws, which say that marital property is deemed and actually owned by each member of the marriage. So in Texas, a spouse is treated as actually owning his or her spouse's business. And as a result of that, the non-involvement exception does not apply in businesses in community property states. What the bill does is overturn that. That says specifically for purposes of determining a control group, the community property laws would be disregarding in determining ownership. And so if my doctor, lawyer, if they were in Texas that I just mentioned, today they'd be a control group. If this is enacted, and it's effective almost immediately, the day after, plan years beginning the day after enactment, we will no longer be a control group. And that means I can have a defined benefit plan covering just my employees, and my spouse can have a 401k plan, and we don't have to worry about pesting them together, if you will. An additional family attribution surprise for many deals with attribution from children. And if you have a minor child, your minor child is deemed to own what you own. So once again, if the doctor and the lawyer have a minor child, even if they're in a non-involvement state, no community property, they meet the non-involvement exception. Nevertheless, the minor child makes it a control group because the minor child is deemed to own 100% of the father's business and 100% of the mother's business. That too would be repealed by the by Secure 2.0, and so I know a lot of people are when I talk about these rules, they're even surprised to say, "You mean I got to worry about this?" Well, you have to worry about it now, but hopefully with the new law, things will be changing. Moving on. Retirement savings lost and found. The bill would set up a database overseen by the PBGC that would collect information on forms already being filed, 8955 SSA, that would allow participants. The goal is to allow them to search online to see if they've left any money behind. It's effective 2 years after the date of enactment. It also increases the cash out threshold under 401(831) from 5,000 to 6,000. And then lastly, it sets up within the PBGC a trust to receive automatic rollovers, kind of, for participants who have $1,000 or less forced cash outs. Right now, you can force a cash out of $1,000 or less. Most people do send that to an automatic retirement account to take advantage of the various safe harbors, unless it's less than $250, I think. But this, you won't have any choice. For automatic rollovers between 1,000 and 5,000, or going up to 6, you can still automatically roll them over if you don't get anything back from the participant. But for the smallest cash outs, you'll have no choice. They'll have to go to the PBGC. EPCRs, it extends the correction period for inadvertent failures basically until the IRS catches you, as long as it wasn't an egregious failure. It also directs the IRS to promulgate more examples, allow correction of inadvertent failures, various other directions. It's helpful. Sometimes the IRS listens, sometimes they don't. Overpayments. The bill has a long set of provisions dealing with what a plan should do if they mistakenly pay too much to a participant. There has been a belief, and that the fiduciary has an obligation to recover that excess payment. The IRS has tried to soften that, and in EPCRs, and in fact, the new EPCRs has some more language there dealing with DB plans. I am not in a position to talk about it, but what the bill does, it makes it clear that you do not have to seek recoupment. You can consider the hardship it might cause the participant without violating your fiduciary duty. And it places restrictions on how you recoup it. That you got to do it within 3 years. You can't just suddenly, cut off their ongoing payments. You've got to do it, a small amount. So it's an improvement. QBADs, Qualified Birth Adoption Distributions, part of Secure 1.0. There is an ability to repay a qualified birth adoption distribution outside of the normal rollover rules. The problem was Congress never put a time limit on when you could repay that QBAD. They have since, will in Secure 2.0 make it a 3-year limit and make that retroactive as if included in Secure. So any QBADs that have already been made will have that 3-year limit once this is enacted. Participant notices, there are folks, DOL went to e-disclosure. There's certain requirements to do it. The bill, the AARP and others are very fearful that the DOL rule will be troublesome for senior citizens who don't have much access to the internet or don't know how to use a smartphone. So the bill would require at least once each calendar year a paper benefit statement be sent to the participant. Whoopee. Also in participant notices directs a commission of DOL, IRS, and PBGC to come up with a report to consolidate, simplify, standardize, and approve applicable reporting. Big deal. Don't hold your breath waiting for something to come of that. But one good thing is it would allow you to stop sending notices, all the ERISA and IRS notices, to a participant who does not have an account balance. You have people who get eligible to get into a 401k plan and for whatever reason never contribute. Yet we have to keep sending them notices at various times during the year. What this would do is change it to a once in the year notice, reminding the participant that you're eligible and here's the key parts of the plan you should be taking advantage of. Lifetime income. Again, Congress says that people believe lifetime income, i.e. annuity type distributions, are beneficial to retirees because it reduces the risk of investment risk, longevity risk. It's all these great things, but in any case, it does a technical fix to the minimum distribution regulations in how they deal with annuities, satisfying those minimum distribution rules. And essentially what it does is allow some more common deferred annuity or annuity type benefits to be offered that have become popular but run afoul of those 401A9 regulations. It also increases the QLAC limit by removing the 25% cap. The $135,000 limit still is in a place, but it can be up to 100% of your account value could be invested in a qualified longevity annuity contract, which is essentially a deferred annuity. You guys, you're mostly financial advisors out there. This to me, I thought was a problem that a solution looking for a problem that really doesn't exist. Long story short, back in 2008, we got the 2010 rather, the 404C regs. We got to give them the chart, compares each designated investment alternative to a broad-based securities market index. For the last 11, or at least for the first 2 or 3 years, there were complaints that broad-based securities market index didn't match up with target date funds, and it should be permitted to use a mixed asset class benchmark. We've somehow survived for the last 11 years without the fix. This does then finally fix to allow a more appropriate benchmark, many would say, for target date funds offered as designated investment alternatives. Another big whoopee. Qualified charitable distributions that allows, the bill would increase the limit from 100K by cost of living adjustments beginning in 2022. Although there hadn't been any COLA on that in the past, it would also allow up to $50,000 to be donated to a split interest trust, which is a gift annuity, a charitable remainder unit trust, or a charitable remainder annuity trust. These are all very helpful in estate planning. To be honest, I'm not an estate planning lawyer, but there are also some requirements. You can only use it once in your lifetime, various other rules. So if that's appropriate for one of your clients, you may want to, again, look into this once it becomes law. 457 participants could make deferral elections anytime before the compensation is paid rather than having to do it before the month in which the compensation is paid. Again, a big whoopee. You would be allowed to amend the plan retroactively to increase benefit accruals. I'm not sure really how much useful this will be. There are not a lot of money purchase pension plans out there these days. But the idea this would work on sort of the same basis as if you can establish a new plan up until the due date of your tax return, you should be able to increase accruals up until the due date of your tax return. Again, Congress is always looking for people to help. Victims of domestic abuse would be able to get a distribution that is free from the 10% early distribution tax and could be repaid within 3 years. What else? Plan amendments. All right, we've gone through the substantive provision.
Craig, before we move to plan amendments, may I ask a question here? So in regards to the income solutions, do they have to involve an insurance company, or as an advisor, could you do some sort of pooling of your own insurance company costs?
To be honest, I'm not sure the answer to that question. I think the 401(a)(9) provisions were clearly aimed at true annuity products. The qualified longevity annuity contract, likewise, if I'm not mistaken, does have to be an annuity product issued by an insurer. So I don't think it would allow you to set up your own pooling. That doesn't preclude a plan from offering lifetime income distribution options, whether it's a payments over a fixed period of years or ad hoc withdrawals, but these provisions are aimed at the insurance annuity market. All right, quickly, plan amendments. The point to be made is the deadline will be the 2023 plan year. For most plans, governmental and collectively bargained plans have an extra 2 years. And the deadlines for Secure 1.0 and the CARES Act have been moved back a year as part of this legislation, so that all three bills, 1.0, 2.0, and the CARES Act, will all have the same amendment deadline. And lastly, then, to finish up here, tell me, Craig, is this really going to happen? And I will tell you, personal opinion, think it is going to happen. I can't guarantee when that will be, but I think it's highly probable it will be in this Congress, and in all likelihood, within the next year. The bill has passed out of the House Ways and Means Committee. It has to go to the House floor for a full vote, and then it goes to the Senate. The House is slated to adjourn at the end of this month for their district work period, also known as vacation or recess. In any case, it depends on how much time is available to debate bills such as this, given other priorities. So I think once it gets to the House floor, it'll pass without any problem. As I said, Secure 1.0 passed 417-3. In the Senate, Secure 2.0 is likely to be based on the Portman-Cardin bill. And I'm sorry, I fixed the header, but not the first bullet. They actually have reintroduced, as I mentioned just recently in May, their 2021 version of the bill. There are at least 16 provisions that are identical. There are actually more at this point. I just haven't had a chance to go through and count them again. And so you've got a Senate bill. That Senate bill likely will, the Portman-Cardin bill, will morph into a bill that is presented on a bipartisan basis by Senators Wyden and Crapo, the chairman and ranking member of the Finance Committee. And because it's bipartisan legislation, at a time when Congress really wants to be seen as being able to do something, this has a chance of going forward. Now, it is likely never to get enough time to be debated on the floor of the Senate. The Senate's floor time is very short, and it's controlled by Mitch McConnell. Where this bill is likely to end up is the same place Secure 1.0 did, as a caboose on a legislative proposal, a train that's going down the tracks and has a must-pass bill. That could be the year-end spending bill. It could be raising the debt limit. Both are must-pass bills that often have legislation attached to them. Even if it doesn't go then, I think there's going to be a real effort to get this passed before the midterm elections so that Congress, the members of Congress can go out and say, I'm doing bipartisan things. Remember that Retirement Reform Act. And so you never know. It's politics. However, I think it is time. I think you all are in the business. It's time to consider, what this means for your clients and for your practice and how best to take advantage of it. All right. Any questions? James? Did I lose you?
No, you got me here. I think we're all clear.
All right. Then I got 2 minutes. I'm just not going to spend any time other than to tell you Richie Neal is a very powerful congressman, chair of the Ways and Means Committee. One of his priorities is to mandate every employer in America have a 401k plan to which the employees can make elective deferrals. He's not mandating any employer contribution. Small employers would be accepted, new employers for less than 3 years, churches and governmental entities. But this is a Democratic priority. Republicans are against mandates. So one might say in this divided Congress, where's it going to go? And where it might end up is the budget reconciliation package of tax incentives and the like that the Democrats are planning to push through on a 50-50 vote, which reconciliation allows. So this too may be coming sooner rather than later. Lastly, you've heard about the Wall Street Tax Act. There'd be a financial transaction tax on each time a security is bought or sold. Big in the Democratic side of the progressive side, even that of the Democratic Party. I don't see this going anywhere right now, not with Congress divided the way it is. And so, folks, I hope you enjoyed being with us. I hope you found it worthwhile. And we'll join us again in the future when we do some more of these kind of Washington Update webinars. Who takes it, Jim?
Yep, I'll close this out here. Thank you very much, everybody, for joining us. We will be sending the slide deck, and this has been recorded and will be available on our YouTube page for those of us that like to consume education. Most of the time I do it is driving behind the wheel. So again, we appreciate everybody, and have a great rest of your week.
Bye all.
Thanks, Craig and James. And again, the recording of the webinar will be made available on our NOVA YouTube channel by the end of next week. Everyone have a wonderful day. Bye.